Good morning and welcome to this Wednesday, January 20th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. We do have futures looking pretty decent on Inauguration Day. Dow Jones futures currently up 89 points, S&P 500 up 18 and a half. And the NASDAQ having a very strong morning so far, up about 129 points, which is about 1%. Big part of that is Netflix. We'll talk about that. Netflix came out with its earnings last night. They missed on their bottom line, but they did come in way ahead of subscriber numbers and raise some guidance going forward. So we'll talk about that later in the show. But Netflix certainly aiding the NASDAQ futures this morning. All right, let's go ahead and take a look first at earnings beats. If you're not familiar with earnings beats, let me just give you a quick little rundown of a couple things I think you might be interested in. We do have a free Earnings Beats Digest newsletter. Type in your name, email address there, hit the subscribe button. We'll get you signed up. No credit card required. You can unsubscribe at any time. The newsletter comes out 3 times a week, talks about lots of different things, individual stocks, occasionally ETFs, relative strength. Sometimes try to predict earnings reports based on what we're seeing on the charts. A lot of good stuff in there, so you can sign up. Again, it's free. If you'd like to try our service, had a really good session last night. We had what we call our draft. Actually, we have 8 of these a year. We have drafts every quarter for our stock portfolios that are on February 19th, May 19th, August 19th, and November 19th. And we started our model ETF portfolio on October 19th. And so now every quarter we're doing our model ETF portfolio draft on January 19th, April 19th, July 19th, and October 19th. So those will be the dates. So anyway, last night we did have the model ETF draft. You don't see that on here. We're going to start getting our ETF portfolio performance up here. It's actually quite good. But because we have different inception dates, the S&P 500 this quarter and performance this quarter is different than ETF. And so originally we put it up there and then it just didn't make a whole lot of sense. So we'll get that up separate. That'll be coming soon. But I'm going to spend a little time later in this session just talking a little bit about that model ETF portfolio and our results last quarter, which were pretty good, as I said. But let's go ahead and take a look at what happened yesterday in the market. This is a holiday shortened week. We had Martin Luther King Day on Monday. Markets were closed. So Tuesday was the first day of the week. So this will only be a 4-day week. And I thought things got off to a pretty decent start. Dow Jones, you can see, up about 0.4%. S&P 500, double that at about 0.8%. And the NASDAQ almost double the S&P 500 at 1.5%. Small caps and mid caps also outperformed the S&P 500, but they did not outperform the NASDAQ. Still, all 5 of our major indices moving up, all 5 above their 20-day moving averages, all 5 of the 20 days above the 50 days. I mean, this is the configuration of a bull market advance. So we are in the midst of one. I will say, we have now exited what is historically the best time of the year for U.S. equities. It doesn't mean the rest of the year is no good. It just means that our best time historically runs from October 27th at the close through January 18th at the close. Now this year, January 18th was Martin Luther King Day. So it was actually January 15th, which was last Friday. But still, we've gone beyond that period, got off to a good start yesterday. I think we're going to probably have a period of selling and consolidation at some point here in the next week or two, I would imagine. Just as we're going through earnings, maybe we get a little bit more of a pop as we're heading into some of these tech companies reporting, and we're certainly going to get a lift from Netflix at the open today. So it's hard to predict exactly when we'll pull back, but just the history of the market is that we tend to bid these shares higher heading into earnings season. And then once earnings starts to come out, we start to see this buy on rumor, sell on news effect. And so second half of January is not nearly as bullish as the first half of January. Just got to keep that in mind, more so for expectations. I'm not looking for a major sell-off, but also I know history tells me that once we start moving into the back half of January, we don't typically see huge runs. But we are in a secular bull market. I would remain long. I would not be shorting the market, that's for sure. I think I've been pretty clear about that for some time. And I don't like to short anything in I mean, maybe a specific stock, like as we head into option expiration, that might be just a one-off kind of a case where you might short an individual stock because you have to feel like it's in the best interest of market makers to take a stock lower. But just in the general scheme of things, I would stay away from shorting. There's so many stocks that look so good technically. Why we're trying to find a needle in the haystack that's going to go lower when everything else seems to be going higher? That just seems like a fruitless uh, adventure that I'm not really going to be too interested in doing. All right, looking at the sectors on Tuesday, energy. Energy struggled at the end of last week. I think a lot of that had to do with options expiration. But we did come back up 2% on Tuesday. That was good action there. And you can see the configuration here now. Energy is much more bullish. Things were not looking good back at the end of October as we were trending down. But since we cleared the 20-day and since that 20-day cleared the 50, you can see energy's been rebounding. A rising tide lifts all boats. I'm not a huge fan of energy, still not, even after the move to the upside. I just think there are going to be some headwinds that energy is going to have to deal with. Still, there's a lot of supply out there. So even as demand picks up, I think we've still got an issue with supply. And then also, I believe the dollar is going to rise. And if the dollar rises, that's going to provide headwinds for energy. I think energy goes higher. I just don't think it outperforms the S&P. Communication services, also strong day, up 1.8%. I was talking about this. I mean, that was just the price where it just seemed like it needed to bounce. We had a high over here at about 65. The prior high at the beginning of September, right near 65. We were up to 68. We pulled back, hit 65, and that just seemed like a good area to bounce. And that's what we did, up 1.8%. Technology continued to consolidate, but it remains in an uptrend, remains strong. Renewable energy, moving on to industry groups, renewable energy. Remember, it lost 9% on Friday, option expiration. Miraculously, up 9% on Tuesday. Shocking, right? So all of those options that expired, of course, this is still a little bit surprising it bounced back as quickly as it did because I'm sure there were plenty of options that were exercised on Friday. But still, it just doesn't pass the smell test when the index is right back where it was at Thursday's close. But it just, for whatever reason, a little sarcasm there, for whatever reason, dropped a little bit on Friday, or 9%. Anyhow, renewable energy bounced back on Tuesday. Non-ferrous metals, also a really strong day. You can see this has been a strong group for quite a while. This is really leading the materials group. And non-ferrous metals, for the most part, we're talking about Freeport-McMoRan, FCX. That stock's been absolutely a monster, and that's what's leading this index to the upside. One group that I didn't mention here that got a pretty nice lift and helped communication services was internet stocks. Internet stocks had a really nice day. I think Facebook was upgraded and had a strong day. And so many of the internet stocks saw some pretty nice strength on Tuesday. So just wanted to mention that one. All right, moving on. Let's take a look at the 10-year Treasury yield. This morning, in terms of economic news, not a lot out. January housing market index will be out at 10 a.m. The expectation there is for 86. December was 86. So, and I'll tell you, I don't know what everyone else is seeing around the country, but I can tell you here in this area, housing prices are absolutely exploding. And there's so much demand and so little supply. And for those of you who don't know, I'm in the Charlotte area. So right around, southern, southwestern, whatever, North Carolina into South Carolina, which I'm just over the line in South Carolina. This area, the housing has just absolutely exploded. It's hard to get a home. You got to bid up and try and outbid other buyers. It's absolutely crazy. Anyhow, just thought I'd mention that. But the January housing market index report will be out later this morning. Let's move on. Well, actually, let's take a look quickly at the 10-year Treasury yield. It hasn't really seen too much of a move today. We did gap up 1 basis point to 1.10. Again, I look back at that black candle, that black filled candle off of this uptrend, and that tells me we're probably short-term going to consolidate these gains. We could make our way back down to 1%. Maybe we go back up to 116, 117 first. But I do think we're going to have some sideways consolidation here for a period. And that might make it a little tough. You might see some profit taking on some of the banks as they report their earnings. We're seeing a number of them report earnings and not necessarily get great reactions to what looked to me like pretty decent earnings reports. And I think it's because a lot of that was already anticipated. So watch the 10-year Treasury yield. Unless we get a breakout there, I would expect more consolidation in the banks specifically and maybe financials in general. Talking technically, let's, when you invest in small companies, the thing, and I always seem to be in these at the wrong time, but the one thing you have to be really careful about with, especially with small companies, is when they make runs to the upside, that is a license for them to print money in terms of selling shares. It's amazing to me. And, when you're watching a stock like GEVO, when it's trading down here around $1 or whatever, and it's been down for a while, they don't come out with, these share offerings to raise capital. When these small companies come out, they try to take advantage of the huge increase in their share price because then they can raise money without having to sell as many shares. If they sold shares at $1 and they wanted to raise $100 million, well, they'd have to sell 100 million shares. But when the stock gets up to $10, if they want to raise $100 million, they can divide that by 10. Or instead of 100 million, 10 million shares would get them the same amount. So you don't dilute as much. And so if a small company wants to raise cash, the best time to do it is after you get this big move. So you can imagine what my next comment's going to be here on GEVO, because the stock was up $4.63 yesterday, 72%, went up to $11. And if you're guessing that they announced an offering, you would have guessed right. They come out with an offering, stock's down 25% pre-market. And, be my luck to buy a stock like this on a breakout and then have the announcement come out. But you do need to always pay attention and be aware of this risk when you're in small companies. So I'm just going to pull up GEVO pre-market, and there you can see right now it's down 22%. They announced that they have priced their offering at $8 a share. Now, I think this is probably the first of a bigger move to the downside. I think this is the first move down. I wouldn't be surprised to see the stock go below $8 because of the dilution, maybe even move down toward this $6, $7 range. That wouldn't be a surprise. I don't like being in these stocks when they announce. Obviously, I don't want to be in when they announce, but I don't like being in them even right after they announce because they normally struggle for a period of time. And I say normally, some, continue to move higher, but this is going to have a dilutive effect. And that's why the stock is getting hit so hard. Another stock that also made this announcement is Bionano Genomics. Bionano, I don't know if I'm pronouncing that right, but Genomics. So here's a stock that was at 50 cents at the end of December. Now is at $9.14. I don't know the size of their offering, but I do know that they priced it at $6 a share. It was trading at $9.14 yesterday. Got as high as $9.95, almost $10. And now they're pricing at $6. So once again, you can imagine what this looks like. I mean, it's priced at $6. You could get out $7.82, down 14%. I mean, who knows? This is going to be incredibly volatile. I just believe in time we'll see this stock go lower. It's my opinion. Maybe, some of them are different. One thing I would count on is volatility in both directions. Emotional swings, the psychological impact of trying to trade a stock like this is very difficult. You jump in, or you say you jump out at 782, you think, oh, this is going down to 6. Next thing you know, it's back up at 9. And you're like, oh, I guess I'm okay. I'm going to jump back in at 9. And then it goes to 6. And you literally think that the stock market is rigged. Well, it is to some degree because market makers have to do their thing to get institutions either in or out. And they are able to accumulate or distribute shares based on our emotions. That's how they do it. They know if a stock price goes up, that there are a lot of folks that like to chase and get really excited and emotional about a stock, and they'll buy. And that's a great way for a market maker to sell into that strength. So buying and selling these small companies, I just point this out because we are starting to see small caps explode to the upside. And this is just kind of the tip of the iceberg, and as far as I'm concerned. I love small caps. I think they're going higher, but on a case by case basis, just be prepared if you trade a lot of individual small caps. Now, in the case of GEVO, I will say, and I didn't go back and look at BNGO, but GEVO announced 3 weeks ago that they had amended their articles or whatever to allow for the selling of additional shares. So they kind of played their hand a few weeks ago. I think that was on December 30th. So if we go back and we look at this chart on GEVO, the stock was down 20% that day. Yeah, so I think it was right in here. Maybe it was one of these days. I don't know. Or no, it was the end of December. It's right here. I think it was this day right here where we gapped down. It probably traded like at 480. Next day we went down to about $4. I think we were down close to 20%. And the reason for it was that announcement that they had made that adjustment and that they were prepared to issue more shares. Now, they didn't issue more shares. They didn't announce anything, but they just made it so that they could. And that was a little bit of a warning. And sure enough, after we got the big move to the upside, out came the announcement. So just be aware with small companies, this happens. Speaking of small companies, let's take a look at the small cap preview. So, or review. The Invesco has a number of ETFs that track small cap stocks within the various sectors. So for consumer discretionary, it's PSCD. So here you can kind of see PSCD. And actually, I don't even care about the volume. Let's get rid of the volume. So there goes PS, and actually accumulation distribution. I don't care about that either. I really just want to see how it's performing. See if we can get most of this on the chart. Okay, so here we've got the PSCD. So this is small cap consumer discretionary. Down below, PSCD divided by the XLY. So small cap consumer discretionary relative to large cap consumer discretionary. So, consumer discretionary, the XLY, large cap, you got a lot of Amazon in there. So you can see that small caps are outperforming the large caps. And part of that is just Amazon, the largest holding in the XLY, has been sideways consolidating, continues, looked like it was breaking out of a symmetrical triangle a couple of weeks ago. Now it's kind of fallen back into it. Hasn't broken out. I think Amazon's going to break out. But for now, right now, small cap consumer discretionary doing very well. Now, if we go to the next one, let's look at materials. And so PSCM divided by the XLB. Here's PSCM. Look at it. I mean, we've talked about materials doing really well. Small caps are exploding relative to the XLB. All right, let's take a look at what else do we want to do? How about energy? Energy's been on fire. All right, so energy, small caps, you can see, have taken off here. On a relative basis, though, even when the group was going down, small cap energy was going down, relative to large cap, it was going up. And so when it finally broke this downtrend in here and started moving up, just right after that, it broke a major area of relative resistance. So small cap energy is outperforming small cap or large cap energy. All right, how about financials? Financials have been doing really well. So let's change this up. And there are the financials going up. And on a relative basis, large cap actually have held up pretty well versus small cap. Small cap made the move back in December, but it's pulled back. I mean, looks like we're trending higher, but not quite the same. Small caps in the financials not doing quite the same on a relative basis as some of the other small cap areas. How about industrials? There's your industrial chart. Look at the relative strength of the small cap industrials versus the XLI. Pretty amazing. How about, I'm sure you want to see technology. I certainly wanted to see technology. What's small cap technology doing? Technology itself has struggled. Look at small cap. You see any struggle going on? I would say there's not a whole lot of struggle. Small cap technology. These companies are coming back. They tend to grow their earnings very fast. This is a group you want to keep an eye on, continue to trade or think about trading. Anyway, I thought that was helpful just to get a sense of not just the fact that overall small caps are doing well, but if we go sector by sector, just about every area, and I would say maybe financials would be the one minor exception. It's trending higher, but it's not going up like the others. But some of these other groups, consumer discretionary, technology, I know we've been focusing on a lot of the big names for the last year, but we need to be thinking about some of these smaller names. And those charts, I think, prove that. All right, let's move on. I want to talk a little bit about the model ETF portfolio. Pretty proud of these portfolios at Earnings Beats. They've done exceptionally well. We've had so many testimonials from members who have written in talking about how this completely has changed the way they look at the market. They've had the best year they've ever had. I've had folks write in and say, listen, I've been doing this for 50 years. I've never seen anything like this. Not just the model ETF portfolio, but our stock portfolios as well. And I'm just saying it, I'm repeating what we're getting back. And trust me, I know the numbers. I mean, again, go back and look at these numbers. Here, you go to earningsbeats.com. You can check these out every day. We update them every day. Model portfolio now is up 228% in 2 years and 2 months. And if you think that that was a fluke, well, aggressive and strong AD, look at the aggressive, ready to become a double in a year and 8 months. Strong AD, almost a double in 8 months. Think about that, 93% in 8 months. It's 10 equal weighted stocks that get adjusted every quarter. Look at the quarterly performance versus the S&P 500. This quarter, aggressive stocks up 29%. Why are they up so much versus the S&P? We focused on small caps. We don't just look at these charts. These charts are what drive what we do. We certainly don't listen to CNBC for our direction. We want to follow the charts, follow where Wall Street is putting its money. That's really critical. So anyway, let's get back to that model portfolio, because here are the 8 model ETF portfolio component ETFs that we had last quarter. Now, these are all gone. We're out of them as of the 19th of January. So we announced last night the new ones for the next 3 months. And if you go over to Earnings Beats, click on that join today, it's a free trial. You pay $7, we refund it to you within a week. And then you got 30 days to enjoy the service. You can see all of our ETFs. But here, anyhow, I put the S&P 500 in here just so you can see what the benchmark did. And then you can see what our various ETFs did over the last 3 months. Because again, we did it as of October 19th. So over the last 3 months, you can see 3 of our ETFs outperformed the S&P, 5 underperformed. But our total gain, and let me get this for you. The total gain in our model ETF portfolio was 16.92% for the last quarter. The S&P 500 was 10.85%. As you can see right there, there's your 10.85%. So our model ETF was 16.92%. We outperformed by more than 6 percentage points in 1 quarter in a widely diversified ETF portfolio. I mean, we have a method to our madness putting these together, but you can see we had clean energy, we had online retail, we had the QQQ, which is the NASDAQ 100. We had transportation average, we had the internet index fund, home builders, the XLK, which is technology. And then we did a growth ETF, a SPDR, S&P 500 growth stocks. That's a lot of diversification in this portfolio to be able to still outperform by 6%. But the real winner, the one that really helped us, we put a small bet, a direct bet into the clean energy ETF, which went up 81% in the last quarter. And 5% of our portfolio was in that. So 5% times 81% is 4 percentage points. So our 16.92% that we gained 4 percentage points of that was due to this very small investment in clean energy ETF. The online retail ETF, 20%, you can look at that. That's 29, let's just call it 30%. 20% of 30% is 6%. So we made 4% on the clean energy. We made 6% on this online retail ETF. That's a total of 10 percentage points. The S&P only went up 1085. This and the percentages that you see is how much we put into each one of these. They total 100% if you add them up. But these two, which totaled 25% of our portfolio, essentially matched the S&P 500. Just the gains on those two. All of our ETFs went up. I mean, 8.5% in a quarter. That's nothing to sneeze at. That was our worst performer. Yeah, we underperformed the S&P. You pick enough ETFs, you're not going to outperform the S&P with all of them. The hope is, just like with our stock portfolios, that there's one or two that where you really get it right and it takes off. And we had those two. We had the online retail crushing the S&P, tripling it. And then we had clean energy, which absolutely exploded. So that's the whole idea. We try to look for themes in the market and allocate our ETF portfolio accordingly. So anyway, great result. Again, go over to Earnings Beats and check us out if you'd like to get the new ETFs for our model ETF portfolio. And by the way, for members, I wasn't able to send out that model ETF portfolio chart list yesterday. I didn't get it to Aaron, who was going to put that on our website. I'll get that to you today. We'll make sure you have it. I mean, you have all the ETFs, but if you're not familiar with Earnings Beats, we actually send our chart lists out to our members. We have links on our website. All you do is you click on the link and you can download it right into your Stock Charts account. But you do need to be at least an extra or a pro member. You need to be one of those two. If you're a basic member, you only can have one chart list, and that's your default chart list. So you can't download any of ours because you don't have room for it. So you need to have at least an extra account at Stock Charts, which I think from basic to extra is $10. Trust me, it's worth it. Just everything you can do. But the big thing is going from basic to extra is you get, I think, 250 chart lists instead of one. So all of a sudden you can keep your own chart list. You can download our chart list. We probably have a dozen or so. Maybe there's more than that now. I don't know. But those are chart lists that our members can download. We do all the research and the work and provide them to you, and you just download them into your account. It's a pretty cool service. And I want to thank Stock Charts for that too, because it is nice to be able to share our work with our members and so forth, and they made that possible for us. All right, let's move on. Earnings. Just going to go through a couple of these. First one, got to talk about Netflix. So let's pull Netflix up. Well, Netflix is pulled up. 501, but let's go over here and let's use this one as the pre-market. It's up $67, 13.5%. So again, that's why you're seeing NASDAQ futures so strong today. Big move on Netflix. I think Roku, Disney, both up as well in sympathy. Not nearly as much. I think more in the 1-2% range. But it's definitely lifting stocks in that area because of the huge addition in subscribers. So I think their subscriber additions were 8.5 million or something, and the expectation was 6 million. I mean, it absolutely blew the subscriber numbers away. Bottom line, they actually missed earnings. So this move to the upside is all about the future. It is not about looking back at last quarter. All right. So that's Netflix. And Netflix had not been, very good performer. And you can see it's opening up here at around 5. I think it's got to get through 575. Let me see. I didn't actually realize. So I would be watching 567.98. That was the highest candle body on this chart. Do we open above 567.98 or do we open below it? And I know you might think I'm crazy, but a penny could mean the difference between whether or not this stock is ready to break out or if it's just going up and testing resistance. If it opens below, and we're going to know in about 20 seconds here, but if it opens below 567.98, even if it goes up to 590 intraday, you better be careful, because if it reverses, comes back down below that 567.98, I think you're going to put a long tail to the upside, a false breakout, and you might be suckered into holding throughout another period of consolidation. If it opens above, or if it closes above, even if it opens below, if it can close above, that would be good. But I'm just a little suspicious if it doesn't make that open. Okay, we just opened. So where did we open today? 565. So we did not make the breakout on the open today on Netflix. Just for the fun of it. Well, it's not fun if you own it, but if you don't own it, just for the fun of it, watch and see what happens Netflix today. If it goes up, takes out these prior highs intraday, and then comes back down the end of the day, I personally would be a seller of Netflix in the near term. I actually really like Netflix long term. I mean, when you start looking at their long term weekly charts on Netflix, I mean, we're just sideways consolidating. We're waiting for the next explosion, I think. We'll see whether or not that happens today. Earnings are starting to pick up, but there wasn't a lot of major reaction to earnings. So I'm going to just pull up a couple that I thought were good. PG, Procter & Gamble, I mean, they guided their fiscal year 21 revenue and EPS higher. They also beat easily $1.64 versus $1.51 on the bottom line, and the stock is down. And it was already heading down. I don't know that this is as much a I don't know that necessarily the market is saying that they don't like Procter & Gamble as much as the market is just saying we don't like consumer staple stocks. Consumer staples have been getting hammered. So I don't know. The report looked pretty good to me, but apparently it wasn't enough to convince buyers. And you can see the AD line not too far from a 52-week low. So it's been a great quarter. It was a great quarter for the stock. They raised guidance. Market doesn't seem to care. Now, could we come back with a huge reversing candle? Yes. And if we got that, I would expect that what we're seeing is accumulation. So look for that. We get a piercing candle or maybe a bullish engulfing candle. That might be the end of the selling for Procter & Gamble because the fundamentals were not bad based on what I'm seeing. Another one I wanted to mention, and I believe these semiconductors are going to report huge numbers, and ASML was one of the first to come out. They were expecting $2.91. They came in at $3.85. $3.85. You want to know why these valuations are going crazy? The earnings estimates are blowing numbers out of the water, and then future earnings have to be adjusted much higher. And then when you're discounting those future earnings, down to back to present value using current interest rates, which are historically low, you have to understand the impact of that. And I hope everybody keeps, writing stuff about PE ratios being too high. That's hogwash. You can't compare PE ratios. We haven't had this kind of an environment in my lifetime. I was born in 1961. Early 1960s was the last time we had interest rates like this. But it's not just interest rates, it's the growth. Now we're coming out of a pandemic. We're going to have pent-up demand. We're going to have surges in some of these companies' earnings going forward with historically low interest rates, something we've never seen. And everyone's just going to, the naysayers are just going to watch it go and say, well, it just can't be. The PE ratios are too high, and they're going to watch them go higher, in my opinion. But semiconductors, you got to keep an eye on these. I really like the semiconductors. A couple of favorites I think are awesome right now. Micron has turned the corner, is leading to the upside, and Applied Materials. Those are two that I think are incredibly strong. That's MU and AMAT. Last one I'll do for earnings, Morgan Stanley. It's in the investment services area, and you can see Morgan Stanley breaking out versus investment services, and investment services have taken a big move to the upside. So this is an area within the financials that has done very well. But as I said, I'm expecting maybe some consolidation. Morgan Stanley's made a big run. I like the stock. Goldman Sachs has also made a big run, has turned the corner as well. Both these stocks are leading, but don't be surprised to see a 20-day test. And there, I'd like the stocks a bit more than I do here. Last comment on earnings. I will say this, all the companies I looked at in earnings. And I'm going to say there were probably a dozen or maybe a little more than a dozen, maybe 12, 13, 14. Only one company matched estimates. Everything else, every other company beat earnings estimates. We're early in earnings season, but these earnings reports are coming in very strong. And I suspect they're going to get stronger when many of the technology names, consumer discretionary names come out. I think we're going to see raised guidance, just like we saw with Netflix. They issued upside guidance, both revenues and earnings per share. I think we're going to see a lot of that. And as we see that, I believe the market goes higher. All right, 3 you must see. Didn't really have any set up. So let me just look here. See if there's anything else that just looks good on the scooter reports. Well, let's look at Amazon. Amazon might be trying to move, turn this little downtrend around here. I had incorrectly, and the thing you have to understand with trend lines, which includes drawing triangles because they involve trend lines. Trend lines, you get 2 points on a trend line, it's not really good. If you get 3 points, it's a little better. If you get 6 points on a trend line, it's even better. So trend lines can be really manipulated. And I tell you what, because I want to spend a little bit of time on this, we're going to just make this the last one. We'll just have a one you must see today. But here, I had drawn a line something like that. I think when we got this breakout at the end of December, and what I was looking at was, the squeezing triangle, and there's your breakout. Volume picked up a little bit. I thought that was going to be it for Amazon. Well, I was wrong. And we moved back down. Now you can watch me just move these lines around a little bit. Now I can connect this, and this, and I'm still got a triangle. Now the upper line, what I would do, this is how, technical analysis, when you're not dealing with price resistance or price support, I can tell you, like I did with Netflix, the exact level of price support. When you start drawing trend lines, it's very, very subjective. Some people draw from the intraday highs, some draw from the candle body highs and lows. I prefer the candle bodies. I prefer using this and then this. And if it catches another candle body, that would be great. That's my preference. But in reality, when you start drawing these lines, it is very subjective. And so now all of a sudden, instead of showing this, breakout in late December, now I can just move my line a little bit. And now all of a sudden, there hasn't been a breakout. I think when we get a definitive breakout, you're going to know it. You're going to see a big move to the upside. You're going to see Amazon up 200 points one day. And that is going to be your signal that the triangle has been broken. Now, is that day going to be today? Who knows? Could be. I mean, I really like Amazon. I still like the market in general. But whether or not today's the day, who knows? One last thing before we go, let's just get a quick update on that Netflix stock and see. All right, so here's our move. So we opened below. Now we're making the move intraday in the morning. Morning is not what I'm really focused on. I'm focused on afternoon. Now, you could buy this stock right here and say, I'm buying this because I believe it's a breakout. But I would go back down to the low of the day and have my stop in play, or maybe even, 565 or something. So if it pulled back a couple percent, I get out. So if you want to play it as a breakout, that's fine. Volume's huge. We're breaking out. But just remember, we opened below these prior candle bodies. Let's see what happens with Netflix today. All right, going to wrap up. Everybody have a great day. I will be back tomorrow over at Stock Charts for a recorded Trading Places Live. So please check that out on Stock Charts TV, 9 a.m. on Thursday. I'll be back here at Earnings Beats next Monday. Lots of earnings coming out next few days. Keep your eyes out. Watch. We'll be updating all of our information at Earnings Beats as the information unfolds. Have a great day, everybody. Happy trading.